I'm Mark Learmonth, Caledonia Mining's CFO, and I'd like to run you through a very brief presentation which outlines the results for the first quarter of 2017. As I go through the presentation, certain pages will come up on the screen, but if you want to download the presentation, it is available on our website. You've got the general disclaimer about forward-looking statements. And then just turning to page 3, the summary of the results for the first quarter. In general, it was an 18% increase in production compared to the first quarter of 2016, and lower costs delivered a 96% improvement in earnings per share for the first quarter. Just unpacking some of those numbers. Gold produced, we did just under 12,800 ounces for the first quarter, compared to about 10,800 for the first quarter of 2016. On-mine cost per ounce came down by about 4%, from just under $690 an ounce to just under $660 an ounce. And the all-in sustaining cost, that fell a bit more sharply, by about $100, from $956 to $857 per ounce. And I'll explain that a little bit later. Falling costs that was supported by an increase in the realized gold price, which went up by about 4%, from $1,166 to $1,213. And all of those things combined resulted in a nice increase in gross profit from about $3.9 million to about $5.6 million. Moving down to the profit and loss, the net profit attributable to shareholders increased from just over $500,000 to about $2.3 million. And that again translated into a fairly significant increase in the adjusted earnings per share, from 2.7 cents a share to 5.3 cents a share. Looking at cash, at the end of the quarter, that's 31st of March 2017, we had about $11.7 million of cash compared to 8.8 in the comparable period. And cash from operations, again, we were generating about $1.8 million of cash from our operations in the quarter. Again, I'll give a bit more detail about that when we get there. Looking in more detail at the income statement on page 4, revenue was up 23% as a combination of increased production and increased gold price. Talk about production in a moment. Royalty stayed the same. It was about 5%. Production costs broadly similar, especially if you adjust it for the increase in production. Again, I'll come back into that in a bit more detail. G&A costs. So those G&A costs, that's the cost of Johannesburg, Jersey and London. The overall costs remained about the same, about $1.4 million, which we now believe is the run rate going forwards. So EBITDA increased from 3.3 million to 5.1 million. Depreciation broadly the same. Don't forget that we don't start to depreciate the significant investment that we're continuing to make in the central shaft until the central shaft starts production in late 2018. So notwithstanding the very significant capex that we made last year, we continue to make, that's why depreciation doesn't change. Other income was up. A big contributor to the other income this quarter was the export incentive credit, about $500,000, and we continue to recognize that export incentive credit because we've been paid it by the Zim government in US dollars into our bank account. Effectively, effectively the easiest way to look at that is it's a rebate on the royalty that we pay to the Zimbabwe government. The cash settled share-based payment, about $400,000. That's in respect of the LTIP awards that were made to senior management this time last year, and the increased charge that reflects the move in the share price. Over the course of the first quarter. The share price increased from about $1.10 to just under $1.40, and so that increased the liability. Finance charges still relatively minimal, even though we do have some debt. It's not a significant component for us. And you notice that the tax charge, well, even though the tax charge went up, the effective tax rate decreased from about 57% to 33%. And that of the tax charge, that includes about $464,000 of deferred tax, which is reversed out when we calculate the adjusted earnings per share. And it also includes $148,000 of withholding tax, Zimbabwe withholding tax, which we incur on the movement of money out of Zimbabwe. Zimbabwean income tax was about $760,000, which reflects the 25% income tax rate in Zimbabwe. The NCI, having moved last year from Canadian dollar accounting to US dollar accounting, that's a very transparent number now, and that is just 16.2% of Blanket's net profit attributable to the indigenous Zimbabwean shareholders, and it will continue at that rate for as long as their facilitation funding is outstanding. So that's a review of the income statement. Turning to page 5, just a little bit more detail on production and revenues. So tonnes milled in the quarter increased by about 8% from 114,000 tonnes in the first quarter of 2016 to about 124,000. A pleasing increase in the grade, which increased from 3.16 grams a tonne to 3.42, and also an increase in the recovery, 93 dead up to 93.7. The increase in the recovery is partly due to the higher grade, and also due to the fact that we're now treating the CIL tanks with liquid oxygen, which boosts recovery. And we'll continue to do that until we get a new oxygen plant installed, which should be sometime later this year. So gold production, as I've said, increased from about 10,800 ounces to about 12,800 in the quarter. Average realised gold price I've already mentioned, and so the net revenues increased by about 23% from $13.4 million to $16.4 million. Page 6 just puts the key quarterly production numbers into some sort of historical context. So what you see on the top graph here is our quarterly gold production, and you can see that whilst we do have quarterly movements, the general trend since about late 2014 has been for an increase in quarterly production. And the bottom graph breaks that down. So the bars in the bottom graph, that shows the tonnes milled. The green line shows the achieved grade, and the red line shows the recovery. And you can see that the tonnes milled, whilst it has increased from 2014 to 2016, did fall off a bit in the first quarter of 2017. And it's really that fall off in tonnes milled that obliged us on the 9th of May to revise our production forecast for 2017, to revise that down from 60,000 ounces to a range of between 52 and 57,000 ounces. And again, I'll discuss that in a few moments. We do expect the grade to continue to improve as we increase the proportion of material that we source from deeper levels, which typically has a higher grade. And so by about 2018, 2019, we will be looking at a grade of 3.8 up to 4 grams a tonne. Turning to page 7, just a few words about the dividend. What you see here is a peer comparison, so showing our dividend our dividend yield and also our payout ratio. And you can see that our dividend yield is about 5%, may have gone up slightly in the last day or so. But significantly, it shows our payout ratio is quite conservative compared to other companies. Just a few points about the dividend. Following the re-domicile of the company from Canada to Jersey in March 2016, that effectively meant that for non-Canadian shareholders, they no longer suffer Canadian withholding tax. So depending on where you hold your shares, that was effectively an increase in the received dividend for non-Canadians. Then in July, we increased the dividend by about 22% from 1 1/8 US cents a share to 1 3/8 cents per share. The dividends remain a very important component of Caledonia's strategy for delivering value to shareholders. We've paid dividends every quarter since January 2014, and it's worth pointing out that's through a period of sustained weakness in the gold price, and also during a period when we've invested very significantly to grow the business, to increase production in the future. And also, we did a little calculation. Since we started paying dividends in February 2013, we've paid just over 30 cents a share, and that compares to our current share price of about $1.20, $1.30. Turning to page 8, just a little bit more information on production costs. As I've mentioned, the on-mine cost per ounce fell from $689 an ounce to $659 an ounce. That's a 4% reduction. And the all-in sustaining cost fell by slightly more. That fell by about 9% from down to about $857 an ounce. The reason why the all-in sustaining cost fell by a bigger proportion than the on-mine cost is that the all-in sustaining cost includes royalty, and we also take account at that level of the export incentive credit, which I've said the easiest way to think of the export incentive credit is effectively a rebate on the royalty. So the royalty rate is 5%, the export incentive is about 3.5% of revenues, and it just seems the easiest way to think about that. In terms of cost per tonne milled, you'll see that the cost per tonne milled increased from just over $70 an ounce, $70.20 in the first quarter of 2016, to $73.20 in the first quarter of 2017. And that really reflects the fact that even though we've increased the tonnes milled and there is quite a high fixed cost base at Blanket Mine, we've actually stepped up the fixed cost base at Blanket, particularly on things like the new ball mill, the number 8 ball mill, which we installed late last year. And so we really geared the mine up to cater for a higher level of production. And so in the quarter one's production was less than we'd anticipated, that did give rise to the increased cost per tonne milled. But then the benefits in terms of the improved recovery and improved grade, that resulted in the overall reduction in the cost per ounce. Just unpacking those production costs a bit further, the wages and salaries, that increased to 3.3 million, and that's a combination of increased headcount. So the headcount at the mine increased from about 1,100 to 1,300. Then there was a very modest increase in payroll cost, average wage rates. I think it's about 1 or 2%. So there's no significant wage inflation in Zimbabwe. Then the other difference is explained by overtime working. Turning to page 9 and looking at general and administrative costs. In overall terms, they were stable at about $1.4 million in the first quarter of 2017 compared to the first quarter of 2016. But within that, there have been some changes, and significantly, the employee cost increased from about $433,000 to $667,000. And that really reflects a couple of hires that we made to increase the capacity of the head office team. So in particular, late last year, we hired a chap to do investor relations and corporate development. And then earlier on this year, we hired a company secretary and internal counsel. And so what you should really be doing is you should be looking at the increase in employee costs in conjunction with the decrease in professional consulting fees. Because as we've increased the capacity of the head office team, the idea of doing that is it means that we no longer need to use so many third-party external resources, which are quite expensive. The increase in travel costs, whilst it's a relatively small number, it more or less doubled. That does include the cost of contractors going from Johannesburg up to Blanket Mine in Zimbabwe. And at the current stage, given where we are with the central shaft, there's about 6 contractors a week making that journey. So page 10 shows the progression of our adjusted earnings per share. And you can see that 5.3 cents for the first quarter compared to 7.8 in the previous quarter. Yeah, I think you can see as you look at this, there is a general progression for the earnings per share to increase quarter on quarter. And the table just shows what the adjustments that we make are. Relatively clean, so we have a very technical accounting adjustment to account for the value arising for the employees through the indigenization structure. And then we strip out foreign exchange gains or losses and also deferred tax, which is a non-tax item. So not really very significant adjustments to the earnings per share at this stage. Turning to page 11 and the cash flow. The cash flows from operations in the quarter were 2.4 million, and to some extent you might think that's relatively low compared to the very strong profit generated in the quarter, certainly compared to the first quarter of 2016. But within that 2.4, that hides some quite significant increases in working capital, which I'll just explain for you. In the quarter, prepayments increased by about $1.2 million. And those are prepayments made by Caledonia in South Africa, and that's in respect of equipment that is being constructed and fabricated here in South Africa with quite a long lead time before it then gets delivered to Blanket Mine. And so we're effectively warehousing those assets on our balance sheet, and then we'll eventually sell them into Zimbabwe. Also, as is normal in the first quarter, the receivable from Fidelity Printers and Refiners in Zimbabwe increases. Typically at the end of every December, that receivable is at a very low level, because that reflects the lower level of deliveries immediately before the 31st of December, which is due to Zimbabwean holidays. By the end of March, depending on the timing of Easter, because we're now in the full flow of gold deliveries, typically that receivables goes up, and so that was about $1.2 million higher at the end of March than it was at the end of December. So the two of those together make 2.4 million. And then also there was a reduction in payables, and just about an $800,000 reduction in payables. Part of that is because in February we pay out the accrued production bonus to the workers, and also towards the end of the quarter, as it became easier to make payments out of Zimbabwe, we were catching up on some offshore creditor payments, particularly to people like ZESA, the electricity supplier, who we pay outside Zimbabwe, and also some trade payables for service providers into Zimbabwe. So that's entirely normal. Looking down at the cash flow of investing activities, about 3.3 million, exactly as we were previously, and again that reflects the continuation of the investment in the central shaft. And looking at cash flows from financing activities, the repayment of the term loan facility, that's a new feature, $375,000. As you recall, we drew a $3 million facility in 2016. That's repayable over 2 years. And so over the remainder of the year, so over 2017 in total, we will be repaying about $1.5 million on that facility. So that basically sort of breaks down the cash generation. We ended the quarter with $11.7 million. Just turning to the balance sheet, I've actually already outlined the major features in the balance sheet, and the only really significant thing is the increase in fixed assets, which reflects the ongoing investment at Blanket Mine. And I've discussed the changes in the current assets and the current liabilities, which are just normal working capital movements, which can be understood. One thing I would like to focus on, though, is where we have the cash and the cash equivalents. So of the nearly $12 million of cash at the end of March, of that, 5.6 million was held by CHZ, which is Caledonia's wholly owned subsidiary in Zimbabwe. And between the end of March and the publication of our results, the first quarter results, which we published on the 10th of May, that balance held in Zimbabwe was reduced from 5.6 million to about 3.8 million, and in the last few days has come down a little bit further. So we are now managing to get money out of Zimbabwe more easily. And at this rate, frankly, we would prefer to keep a small balance of cash sitting in Zimbabwe just to cover ourselves the eventuality that Blanket had a short-term funding need, in which case we wouldn't want to go to the trouble and the expense of taking money out of Zimbabwe only to have to pay to take it back in again and re-inject it. So we're getting to a level where we're actually comfortable with our cash holding position in Zimbabwe. Just touching on some operational matters, and I'm the CFO, so I'm sort of slightly straying outside my remit here. Dana, the Chief Operating Officer, is at the mine today, and Steve, the Chief Executive, is meeting investors in London. So they're not available to be on this video with you, but I can just quickly identify some of the issues that we've raised and we've already clarified in some other communications. But on page 13, as we've already mentioned, we do have underground logistical constraints on 22 level. So notwithstanding the improvements that we've made in 2015 and 2016, we're still finding it very difficult to move the amount of material we need to move on that level, both to maintain production and increasingly importantly, to do the development that must be done to make sure that when the central shaft is completed in late 2018, it joins up with the underground development so that it can pretty much start producing immediately. So in recognizing that, a few days ago, we revised our 2017 gold production guidance down from 60,000 ounces to between 52 and 57, so that we can do that development to support the central shaft. And actually, if I could just refer to a slide that we've used in sort of previous marketing communications. What you see here is a long section of the mine area, and what we have to do. You see on the right hand side is the number 6 winze, which goes down from 760 meters to about 870 meters. And the development that we have to do now, and we can't afford to go behind on this, is we now have to start developing across from there to meet up with the central shaft, so that by the time the central shaft's completed, it joins up with this development, so that then immediately we can start mining up into these areas. If we don't do this development, that means that by the time the central shaft gets there, we'll then have to delay the commencement of production in these areas to actually do subsequent development later. So frankly, we have no choice. We must do this development now, and that's the decision that we took when we revised our production guidance for 2017. Talking about the central shaft, that's progressing well. It's now reached a depth of 750 metres below surface and has actually holed through onto the haulage on 750 metres, which, whilst our main focus for the central shaft currently is on deepening it to make sure it gets to the bottom when we need it to get to the bottom, it does mean that having holed through onto 750 metres, it does mean that we can now lower or drop down much larger bits of equipment for use on the 750 metre haulage than we could previously get down the old number 4 shaft. And again, some of those bits of equipment that we might be dropping down in the next few weeks might help to alleviate somewhat the ongoing logistical issues on that level. In addition to the central shaft, work has commenced on some new projects to enhance mine flexibility. So in particular, we've put in one decline into AR South, which has proved to be very successful. We'll be doing another one into AR Main, and both of those are working very well using a new sort of mining and transport methodology, which hasn't previously been used at Blanket, using trackless equipment instead of rail cars, and that's actually worked very nicely. Metallurgical recoveries continue to be strong and have improved slightly as we've now switched to using liquid oxygen to supplement the oxygen that's coming out of our now quite old oxygen plant. And but we are expecting to put in a new oxygen plant later on this year, and we're in detailed contractual negotiations with someone to build that and operate that for us. And we've increased our focus on deep level drilling, and we do expect in the next week or so to put out a further drilling update reflecting the work that we've done. So finally, turning to outlook on page 14, our focus remains entirely on delivering the investment program that we set out on, we embarked on in late 2014. And the objective for that is to increase production to about 80,000 ounces by 2021. There's no change to that target, and we're on track to deliver that. And that remains our primary focus. The implementation of that plan will not only increase production, but it will significantly increase our operational flexibility and give us a much better platform to engage in deep level exploration and drilling and set the mine up for decades to come. As I've mentioned several times, we've revised our guidance for 2017 from 60 down to between 52 and 57. The breadth of that guidance really reflects the current uncertainty as to whether the measures we've already taken and some of the measures we propose to take to address the logistics issue on 22 level, the extent to which those measures may or may not be successful. If none of those measures are successful, and we continue at the rate we've achieved in the first quarter, we'll be looking at 52,000 ounces. To the extent that some or all of those measures are successful, we'll be looking at the higher end of the range. And so as we move through the year, it should become apparent whether we'll be looking at 52 or 57, so that range should narrow. On-mine cash forecasts are broadly consistent with what on the on-mine cost forecasts are broadly consistent with what we announced previously, just gone up 10 to 15 ounces, dollars an ounce, reflecting the lower production rate. And it's fair to say that we'll continue to maintain a very conservative approach to our cash management, make sure that we've got the financial capacity to accommodate any reduction in the lower gold price, and make sure that we can maintain the current dividend. So with that, I thank you for watching. This is available on the website, and we look forward to updating you at the end of Q2. Thank you.